and welcome to Indianomics. The past week, indeed the past 8 weeks, have all been about preventing the rupee from falling. But this Independence Week, I want to turn the tables. Conventional economics tells us that when the current account, that is difference between exports and imports, widens, the currency should depreciate so that imports become expensive, people import less and prefer domestic substitutes. Likewise, exports will become cheaper and increase, and eventually the current account deficit will be bridged. Currency depreciation, even in normal times, is a favored option. The quantitative easing in the United States is all about printing so much dollars that dollar becomes cheap vis-a-vis trading partners, and the US economy is competitive against imports. It's working there. Likewise, Abenomics is all about printing trillions of yen. Already, the yen has depreciated from 75 yen to the dollar to 100 yen to the dollar, and the Japanese GDP is improving. Then why is the Indian debate so skewed against depreciation? One reason could be that some of our imports like crude don't decline despite high prices because we don't pass on the high prices to the end consumer for political mileage. But my bigger worry is that the debate in India is getting hijacked by the following vested interests. One, by a handful of large corporates who have dollar-denominated debt and whose problems have become national problems because they can become NPLs for banks. Second, the government has been refusing to pass on higher diesel prices for populist reasons, and now, closer to elections, doesn't like its subsidy bill burgeoning because of rupee depreciation. Third, FIIs find the dollar returns declining, and their disinterest in Indian stocks hurts the stock markets, stock investors and companies, and these entities dominate the media. Fourthly, the government too wants the FII flows to finance the current account deficit. So instead of accepting rupee depreciation, which will correct the deficit in the medium term, it wants rupee appreciation so that FII flows come in and bridge the gap in the short run. That then is our discussion today. First, what is the data telling us? Do our exports rise and our imports fall when rupee depreciates? And secondly, is my conspiracy theory correct? To discuss this, I have with me Samiran Chakraborty, Head of Research and Economist with Standard Chartered Bank, and Sajid Chinoy, Economist with JP Morgan. Gentlemen, welcome. Sajid, I start with you because you have done a detailed study of Indian exports, you say. Have they increased after the depreciation? See, the July exports increased both year on year and month on month. So to me, it appears depreciation is working, isn't it?
Yeah. Lata, it's a very good question. It depends on what your time horizon is. What we have found in the Indian context is that there is no prima facie evidence that there are large elasticity effects. So we've looked at the question sector by sector. The two sectors where you do find a meaningful price impact and price response is the software sector and the BPO sector. But if you look at the merchandise basket and break it down by sector, we haven't found holding everything else constant, global growth, supply constraints at home, that if the real effective exchange rate depreciates by 1 or 2%, you get any big bump in the export pickup, at least in the near term. Of course, over time, in the medium term, there will be some sectoral reallocation. Now, if there are large jumps, like what you've seen in the last couple of months, you know, a 10% move the nominal rate and therefore a large real rate eventually, that of course will have some impact. But prima facie, global growth, global demand drive India's manufacturing exports much more than the exchange rate does. I'll make one final point. We do find some impact of the J curve, so to speak, on the import side.
Okay,
taking account
Sajid, I'll wait for that. Sajid, I'll wait for the import substitution argument. One would expect that imports should also fall as the rupee declines. But let me handle the export argument first and come back to you for the import arguments. Samiran, your take. Have you done any research, secondary or primary, to find out whether a fall in the rupee encourages exports? Immediate data from July says that is the case, and a fund of a bunch of software exporters who came on our channel repeatedly say that the going is getting better for them.
Okay, in this case, I'm in complete agreement with Sajid that the exchange rate effect on exports is practically not relevant. But let me explain why this is the case. This is primarily because of several reasons. The first one is that if you look at our top 5 exports, out of those 5, 3 of them, petroleum exports, gems and jewellery and textiles, have significant imported inputs. So in effect, the exchange rate cuts both ways, and that's why you really do not see too much impact on the export side. The second is that at least on this merchandise exports, we really do not have too many firms where the brand names are so common in the world that they have pricing power. So in effect, whenever the currency depreciates, there is some arm twisting from the buyers and they have to accept a lower price. And the third issue is about exchange rate volatility. It's not just the level, but the volatility also matters. If it's too volatile, then it's very difficult for exporters to price their exports properly. And last but not the least is the issue of what real exchange rate are you talking about? Is it the 6th country, is it the 36th country, or is it just against the dollar? Against the dollar, the rupee has depreciated significantly, but on a real effective exchange rate based with 36 currencies, we are undervalued only about 10-12%. That's not probably large enough to generate price competitiveness from the exchange rate side.
Okay.
So I am of the view that exchange rate's effect on exports is much limited than what textbooks would suggest.
Okay, well, one looks at the 6 country depreciation, the depreciation of the rupee vis-a-vis the 6 major trading partners, because that accounts for 90%. So 36% perhaps, 36 country comparison perhaps is unfair. With respect to the larger trading partners, the depreciation has been significant. So one would expect that exports should benefit at least vis-a-vis those countries?
Actually, Lata, with 6 countries, the real exchange rate is overvalued, not undervalued.
Okay. So that means there is scope for depreciation. We should allow it.
Yes, as in means the current depreciation is not probably large enough to cause any export effect.
Does not that redouble the argument that the Reserve Bank or the Finance Ministry is picking a wrong battle? If we are overvalued against our 6 major trading partners, why not allow the rupee to depreciate, Samiran?
Well, because of the reasons that I just mentioned, this is a very difficult exercise to embark upon, because the cost-benefit analysis would probably suggest that the amount of depreciation that would be required to have any positive effect on exports will be so large that it will cause havoc on your inflation, on your fiscal deficit, on general corporate sentiment, on external debt financing, etc., etc. So exports is only a part of the problem. There are other challenges, and so a runaway currency depreciation, you cannot allow that to happen just because you want to boost exports.